information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Hello and welcome to another week in property. I'm Margaret Lomas and you're watching Your Money, Your Call. And joining me tonight are two regulars. But before we get to them, first the news, and Property Observer reports that the Reserve Bank could cut the cash rate another 4 times in the current rate cutting cycle, according to Macquarie Group senior economist Brian Redican. Redican says that while the mining boom is driving the economy, other parts are struggling. He predicts that while housing construction could rise a little bit in 2013, it's not going to be a major driver of growth. Now, this means that the RBA will have to keep doing what it's done over the past 12 months by cutting rates. Otherwise, the economy may take another turn down. And RBA Governor Glenn Stevens has suggested that Australian households are coping well with their mortgage repayments as part of his very well-received Lucky Country speech delivered to the Anika Foundation luncheon in Sydney. Stevens says the amount of household income required to repay the median mortgage is at its lowest level in more than a decade. In addition, a high proportion of households are ahead on their mortgage payments, while house repossessions have also fallen from their peaks in Australia's 2 biggest housing markets, New South Wales and Victoria, with the national repossession rate standing at just 0.15% compared to over 2% in the US. Households are spending about 22% of their disposable income to repay their home loan, the same amount that they were paying in 2002. Now tonight I've asked 2 experts in the fields of property, investment and depreciation to join me, and so here tonight and waiting by to take your questions is Brad Beer from BMT and Ben Kingsley from Empower Wealth. Now you can join in on our discussion or even ask any other question about property simply by calling us on 1300 30 34 35. Now if you'd rather put your thoughts down in writing, you can do so and send it to us on an email to property@skynews.com.au. and welcome to tonight's program, and welcome to you both.
Thank you. Thanks, mate.
Well, I guess pretty good news in the news this week, Ben, beginning with the first prediction of another 4 interest rate cuts. What do you think?
I'm not that bullish, Margaret. I sort of see maybe 1, maybe 2 more rate cuts if we're seeing the global economy starting to soften out a little bit or deteriorate more, maybe more than that. I'm still not sure. I'm still sort of thinking maybe 0.25% around the sort of September, once there's a little bit more data for the Reserve Bank to analyse, and then maybe 1 just before Christmas if we need to. But I'm seeing the market pretty stable out there at the moment.
I guess if you think about the GFC, then during that time we were probably one of the only countries in the world not to just cut. And in fact, there was a little bit of a balancing game going on there, with the Reserve Bank even throwing in, I think, an interest rate rise there at some point, and really just trying to massage around and try to keep us around a fairly even keel. There's
no doubt we didn't correct as much as the world economy didn't, and obviously the world financial markets. So what we saw is, our rate sort of pit around that sort of 3.75%, and then we basically started to see some interesting things happen. The actual banks didn't pass on the majority of those rates, and the assessment rates that the bank uses to actually allow borrowing capacity, they were quite sensible about that. And that was the mistake that the Americans made, where they actually put rates down to 0.25%, and if you're on $30,000 a year, you could borrow $400,000, which saw that property bubble form. We didn't see that happening in the way in which we managed the money, and full credit to the assessors and the credit providers in this country for making sure we got through that period. Now we're seeing rates come down again, and we're seeing the same sort of thing happening where the assessment rates the banks are using are still trying to put in that affordability buffer. So when the cycle returns to an upward trend, you're going to see basically more people being able to afford properties when interest rates get back around to their long-term average of around 7 to 7.25.
Of course, Brad, responsible lending there's no question in my mind that kept us in a good position during the last GFC. But I still talk to people today who keep thinking that Armageddon's coming, they think that we can't make it through another global financial crisis. But really, if you think about it, all of the economic indicators are exactly as they were last time, and we made it through then. Repossessions, 0.15%. I mean, that's what it is in a normal market.
Versus, I think, 2% or something it is in America. And I think you look at some of the things that Glenn Stevens is saying at the moment, and he's sort of, got a fair bit of play in the Reserve Bank, and he seems to be a bit more positive about the economy and positive about us not having so many interest rate cuts, and responsible lending stops those things from happening. We've got affordability that's quite high at the moment, or our affordability is better than it's been since 2002, I think you said there.
Yeah.
As a percentage of the cost. That's probably one of the big things that I think had ability to hold property markets back in this country a little bit. But that's at a better rate than it's been, or the same as it's been in the last 10 years.
Mm-hmm. Well, it's come back down again, because at one stage we were headed up around the 30% mark. Now we're back down to 22%. That's really good news, because, so many people keep saying, well, housing is just becoming less and less affordable, but the empirical evidence suggests that that's not actually true. That's just a rumour and a damn lie, as it turns out.
And most guys that in the last 5 or 10 years have told, or 5 years especially, that are talking about this bubble that's going to burst, and 40%, 60%, I've heard it all, of crashes. It hasn't happened, and that was one of the biggest reasons they believe it, or that they seem to think it will cause it to happen.
Absolutely. Look, let's go to the phones, and Michael from Sydney, you have a question for us about renovation.
Yes, I do. Thanks, Margaret. Good evening, and good evening to the panel. My question is regarding renovating a property that's interstate. We've got a property in Victoria, and we live in Sydney, and we're looking at renovating the kitchen and the bathroom. And I'm not sure how to go about it in terms of getting it supervised. Like during the process of renovation, it doesn't form part of the normal activities of the managing agent, so that doesn't seem to be an option. And I was just curious if you had any ideas that we could think about to get it done.
I'm sure that we can help you there, Michael. Ben, you have clients who no doubt would renovate at a distance. How do they manage that?
Look, Margaret, the way in which clients do that, and thanks for the question, Michael, the way in which most clients do that is they actually start to understand what is it your role in the process, and do you have the skill, the ability to actually get that done. Now, if you don't have that skill and ability, you outsource it. So you might go to a kitchen manufacturer who also does the installation. If you're looking at bathrooms, you may be able to coordinate those types of processes. With our clients, what a lot of our clients do is they do start with the property manager, and they ask them questions as to who are good tradespeople in that particular market. Obviously, they're going to be using tradespeople for repairs, but if they've got trustworthy tradespeople, they're certainly a very good spot to start with, Michael.
Brad, you've renovated a lot. Have you ever done it at a distance?
Yeah, I've renovated a lot, but I haven't actually done it at a distance. And I guess I'd probably agree with Ben a lot of that. Whether you can renovate at all isn't just about whether or not you watched it on TV, I think. You need to know that you've got some skills and some abilities so you can actually talk to some trades. I have a building construction management degree, so I've got some idea on how to do that. Renovating interstate, I think you need to get some professional help, unless you're going to go and get hands on yourself if you've got some ability to do that. As you say, good tradesman that your property manager or someone does know, try to get some independent advice on those to drag the contractors in to actually do some of the work.
Look, Michael, I guess you're renovating an investment property, and you're saying kitchen and bathroom, which is normally a fairly standard thing to do. Since it's not a property that you are going to be living in yourself, you're probably not got some kind of an idea around how you like the final product to look. You're not renovating in order to be able to beautify the property for you to enjoy for yourself. Therefore, I think it can easily be done without the hands-on. For that reason, you're more likely just upgrading an old kitchen and bathroom, most likely to attract a little bit more rent and make it more rentable, and maybe compete better on the market that your property's in. I've done exactly that with a couple of my properties, and in fact I have utilised my property manager quite heavily in that, and they're normally fairly happy to do that because it gives them a better property to rent out. First of all, before you do it, make sure that in fact you do need to do this renovation. It's unlikely to add a lot to its value, particularly in the market the way it is at the moment, but it may add to the rent return. So I want you to make sure first that it needs to be done. Often a property exists in an area where most of the properties have older kitchens and bathrooms. It's quite standard and people will still rent them. So I want you to make sure first that it does need to be done and that you're going to get enough extra rent to justify the cost of it. And have a chat to your property manager. As Ben says, they will often know tradespeople who can do it. They'll often know tradespeople who do it for rentals too. And often a rental upgrade for a kitchen and bathroom is a little different than what you would do on your own. And when I did mine, it was actually quite easily managed. I just rang the two guys who were doing them and we liaised over the telephone. They sent me a couple of before and after pictures and I was very happy with all of that. Got my property manager in at the end to make sure the renovation was completed and finished and I could pay that final amount. Kept back half of the amount until I was quite happy with it. So I don't think you're going to have too much trouble, but just make sure that you need to do it first. Michael, also from Melbourne, what can we do for you?
Hi, Margaret and Pennell. I've got a question about Cessnock and the Hunter region. Looking at buying my third investment property and want to get into the region, my question is Cessnock too far away from Newcastle to benefit from Newcastle's growth drivers?
That's a great question and it's interesting because it's actually the second time I've had this question today. I also had that exact question via email from somebody else and it wasn't a Michael, it was actually a female. So Brad, you're from the general area, you're certainly from Newcastle. There's a lot happening up there in the Hunter. Do you think Cessnock's too far away?
Well, I think with Cessnock, it's a little bit out of Newcastle. So if you're looking at the positives in the Newcastle city itself, then you're actually a bit of distance out. You're sort of 40 minutes drive, I suppose, really to get out of, well, depending where you're coming from, I suppose. Maybe a little bit more. So I still think it is Hunter, but you're also got proximity to other mining-related things that are happening that are probably wider. So you're kind of in between. Cessnock itself is still a fairly inexpensive market to purchase in, which is probably a good thing. From respect to the returns you can maybe expect to do. You're sort of in between a lot of the industry, I suppose, and you've got a vineyard area there which is good for tourism, but you're not really in Cessnock. You're not in the vineyard tourism part, I suppose. You're getting some traffic from that, but not that. So I tend to, so if you look at what I've bought, I suppose, in the past, the things I own are closer to town than that, or closer to Newcastle City than Cessnock.
Michael, look, I don't think there's anything wrong with Cessnock, and if you think about the price that you're buying in at, then you're buying in at a very low price, probably around the 200 and sometimes even lower than that. Because you get big blocks there, you've also got that great opportunity to do a granny flat development in the backyard, which is very easy to have approved. It's actually quite easy to carry out. And you can actually really boost your yields up to about 9% by doing that. You buy in at 200, you build a granny flat for maybe 100, and suddenly you've got two rentals at almost the same amounts, and it can be a really, really good option. I don't think it's too far away from Newcastle. I think it's going to get the growth drivers, though, from the Hunter, not from Newcastle. Remember, the growth drivers aren't really coming from Newcastle itself. It is coming from the mining activity that's happening in and around the Hunter. So that's more up around Muswellbrook out towards Singleton and down around Cessnock as well, and it is coming from mining. So I don't think you need to worry about it being so far from Newcastle. You certainly get in at a much lower buy price, and you'll have at least the same amount of growth that they'll get in Newcastle. So it's all relative, I guess, when you consider it that way. Well, Maria has emailed a question for Brad, and she asks, we've just renovated an investment property that we've had for 22 years. The effective life of all assets had long passed, but now we've redone the bathroom, kitchen and laundry and installed evaporative cooling, new flooring and new window dressings. As we have all the receipts, we don't need a depreciation schedule unless we can claim the 2.5% on the basis of the new capital works. Can we? The property is over 40 years old. That's really interesting because always, Brad, people say to me, oh, I've got the receipts, I don't need a new depreciation report. But they do, don't they?
Look, in a situation like this, it's if you've done very minor works, then I'd say, look, you've got some receipts, you've got some actual costs. We should be able to facilitate for your accountant to help you out here. But you've not done a small amount of renovation. You've sort of pulled the place apart here, and you've renovated a lot of things as opposed to that. We'll have a look at everything that's been spent, everything that you have done. Different things will fall into what we call plant and equipment items, and we want to identify as many of those as we possibly can because we'll identify more deductions for you. We do want to take into account all of your actual costs that are available and split them up accordingly. But re-looking at it based on the amount of work that you have done and making sure we identify the right items of plant is something we would do. Yes, you do get the 2.5% against some of those items that you have spent. Some of them will be 2.5%, some of them will be against plant and equipment items. The 40-year number that you mentioned there is the amount of time you get to claim things over. The 40 years old about a property, which I often hear, which is a bit of a mistake, is not the right sort of term to use until 40 years after 1987. The 40-year age is just the 40 years is the amount by, or the time by which you make some of these claims, as opposed to an important age of a property.
Absolutely. And just quickly, is it too late for scrapping?
Well, they've written off all of the things already, so yes, because scrapping only takes effect based on the residual value of items, but they've actually written them off because they've owned it for 22 years.
All right. But if there's something new in there that they did throw away or newer, there might be some scrapping or
Definitely
throwing away
still,
value there as well.
some potential.
Check that out as well. Well, if you watch every week, you'll know that the panel and I pick one question, either from the calls or the email, to receive a copy of one of my books. This week, the chosen email will win my latest book, Investing in the Right Property Now. But this book is all about the current economic situation and explains how you can use knowledge of economics to forecast property hotspots. All you have to do is call or email with a question and make sure that you watch at the end of the show to see if you're the lucky person. Now, you can do that by phoning us on 1300 30 34 35 or emailing us at property@skynews.com.au. It's time now for us to take a short break, but stay with us. After the break, we'll be taking some more calls, answering email, and helping you to navigate the waters of property investing. Welcome back. You're watching Your Money, Your Call, and this is a show which aims to help property investors make sense of all of that information which is out there. Tonight I've asked Brad Beer from BMT and Ben Kingsley from Empower Wealth to help me do just that. So give us a call now. The number is 1300 30 34 35, or you can also email us at property@skynews.com.au, just like this second email, which comes this week from Barb, who's worried that she doesn't have enough time left to invest. And she writes, Margaret, my husband and I are 61 years. We live in Brisbane. Our house is worth about $500,000. We owe $100,000 and we have no savings as such, not much in super, and we only bring in around $80,000 combined. I'd like to use the equity out of our house and buy an investment property, but my husband says we're too old. Are we? I was bequeathed a property in New Zealand worth around $500,000, rented at $440 a week. No money owing on it. It could buy another rental over there and use the equity, plus I have $20,000 in cash. Should I do this, and where do I start? I've been considering this for a couple of years now with the property in New Zealand, but I'd like to show my husband that we're not too old to invest. Well, I don't think she's too old to invest, do you?
Oh, look, there's a lot of question marks I have about this particular email, Margaret. From me, obviously, at that age, it's all about protecting your wealth base and not risking everything for any sort of short-term goals or rewards. The few things that are interesting for me on this particular email is around the valuation of the property in New Zealand and holding that property in New Zealand. We are talking about someone who doesn't have a significant wealth base here, so we're talking about someone who will need to seek some financial planning advice, and I say that around potential pension opportunities and those types of things. So for me, this is a coordinated approach. If you're interested in investing in property, that's fine, but by all means understand that there will be means testing around your pension down the track, and if you're thinking you're going to live to 90 or 100, then there's obviously some opportunity here, but I would be getting advice from not only a finance advisor, I'd also be getting advice from a financial planner, and last but not least, a property investment advisor.
Absolutely. I think it's really important that you do have that coordinated approach to this, because you are getting closer to retirement. And I guess it all hinges around how much longer you plan to stay in the workforce. These days, not everybody leaves the workforce at 60 or 65, and often people go right through until they're 70 and 75. And I gather that we would have to work that out for you. Obviously, we can't give you any kind of financial advice here, but you've got a lot of options at 61, including maybe even accessing your super into a self-managed super fund, and then have a look at maybe investing through something like that that then enables you to access it sooner. There are so many questions to be answered here. in answer to your question, are you too old? I don't think you're too old to start investing. That's the most important thing. Whether it be property or some other kind of investment, that remains to be seen, and that would be dependent on a consultation with a financial planner who will go through all of your goals, all of your assets, liabilities and spending, and work out what's the most appropriate asset for you. I don't think anybody's ever too old to begin to invest. And remember that just because you stop working doesn't mean that the investment suddenly goes away. Often those investments can sit well past retirement, and then you can reap the rewards from that in years to come. Absolutely go out and see somebody, though, who can help you put together a really, really good plan about the future for you. Look, before we just go to the calls, I wanted to comment on a story that I picked up from the newspaper over the weekend, and it's around the demand for rental properties, which still exceeds supply in many parts of Queensland. Now, the Real Estate Institute of Queensland has shown that most regions across the state have a vacancy rate below 3%, many of them certainly under the 1%, and what's happening is they're just not keeping up with the supply factor there. Brisbane, not so much, but certainly the regions, and what we're seeing happening now, of course, is that two-speed economy. I know this is a long-winded introduction, but out of that comes a lot of questions to me about whether now is the time to buy in mining towns. Brad, what do you think about buying in mining towns at the moment?
Buying in mining towns, I'm always a believer in making sure that there's more than just one thing that supports your purchase decision. If you're going to just look at a mining town and there's one mine, you're governed by decisions that are such one-minded and can change, and a GFC is going to impact them, and then it really impacts on the ability for you to continue to get the massive rents out of that property. And also, if the mine moves or something happens, then what's going to happen to the value of your investment that you've invested in for a long time over time? However, mining areas that have multiple reasons to invest in, multiple mining-related activities through multiple companies, and maybe some other industry there, I would much prefer to invest in somewhere like that. Then in saying that, in the smaller area, if you're getting a really big cash return and you're prepared to punt it as part of your portfolio for a period of time, then that maybe makes some sense depending on your risk profile. But assuming that high rental income is always going to be there is something I'm always a bit concerned about. The low vacancy rates, I think, as an investor, I think is not such a bad thing, because my opportunity to get tenants at the moment is much higher than it would be otherwise. The fact that a lot of southeast Queenslanders probably had some not fantastic times and investor activity over the last short period of time is probably driving that. We're not building enough houses. We've still got shortage of supply in a lot of areas, especially in southeast Queensland, I guess, but not all of it as well, or in a lot of Queensland. And I think that low vacancy rates will, or low buying activity will increase the vacancy rates.
Absolutely. Look, let's go to the phones. And Edward from Brisbane, you have a question for us about buying in Lithgow.
Yeah, no, we've got two investments property, Margaret, and what we're inquiring is we've got the two investments plus our own residence, but we've bought a place in Lithgow. We've had it for about 2 years now, and we're wondering if that's an area that's going to grow, or do you think we should sell it and take about 100,000 profit and put it somewhere else that might grow better?
Okay, so is the property you have in Lithgow one of the two that you have as investments?
Yes.
Yes, okay. Ben?
Edward, can I ask another question if you're still there? What's the value of your property compared to the median value for a similar type of property in the area?
In Lithgow you're talking about?
Yes, in Lithgow.
Well, we're talking in Lithgow area itself, they probably sell around about the 380, and as I said, it's only 2-year-old, so they're talking around about the same sort of money.
Okay, so the things that I want you to sort of consider is what's going to drive the value in this area moving forward. Are the incomes going to be strong enough to allow further growth in that particular market? It sounds to me like you've had a good result so far. I mean, I'm a big believer in properties for the long term. To hold that property for 2 years, you might have had a paper gain from value purchase to current value of $100,000. But when you start to think about the interest that you've paid, the buying costs and so forth, The question for me is more around if the economic climate in Lithgow is going to continue to grow and there's going to be income growth in that area and the market's tightly held, you'll potentially see further growth. So it really is going to come around to the question of, why do you need to sell? Is there any other opportunity that you see as being a better opportunity? And if that is a better opportunity, it's got to obviously perform a lot better, because you're obviously going to have the selling and the rebuying costs associated with that.
Not to mention the capital gains tax, which you'll have on $100,000, which you do have to consider, Brad.
Look, as far as selling the property and buying something else, you did mention in there that it's like put the money into something else that I think is going to grow further. Due to the cost of getting in and out, you've got stamp duty back in on the new one. You've got the CGT, or capital gains tax, on the way out, as we said. My biggest issue around buying and selling and trying to go into something else is the fact that you've got to make it perform a lot better. You're going to, at $380,000 you're going to have capital gains tax on a $100,000 gain potentially, and the new property you buy is going to, you're going to be $20, $30, whatever $1,000 behind before you start with something else. And that's my biggest concern over buying and selling, unless it's a really bad asset for some reason, and if you think there's some potential for future growth, I like borrowing against them and buying something else instead. Some more questions around that as to the rest of your financial situation, but that's the way I normally play on the buy and sell. I've got properties in the portfolio that I probably don't like so much, but I still hold them on a long term because there's not enough drive to make me sell them for that reason.
Exactly. And look, I tend to agree with that prognosis from both my guests tonight. I don't see that Lithgow is going to give you any major growth. It's in an interesting position. Lithgow doesn't get quite as much attention as going a bit further over the mountains up to Bathurst and Orange, where the populations are greater and where there's more driving growth. Both Bathurst and Orange have exposure to health, education and mining, which is what I call the triple whammy, and the three things that are most likely to drive growth. You've got the Cadia Gold Mine, you've got the big health precinct over at Orange, and then you've got the university up in Bathurst. Lithgow kind of sits in between Penrith and Bathurst and exists more as a country town than it does as an area that necessarily has a huge amount going for it. Having said that, it does have mining activity close by, and I know that Lithgow is increasing the amount of employment through that mining activity. So what I'm trying to say is I don't see Lithgow at the top of my hotspot list, and I don't even see it on the hotspot list, but it isn't in my no-go zone list either, which means that the reason you would sell it would only be if holding it back was an opportunity cost. So if you needed the money out of that in order to be able to buy something better, the bank won't lend to you until you downgrade or sell off some assets, then Lithgow would be one that I wouldn't be hanging on to thinking that it's going to go crazy in the next little while, and there are areas that will give you better growth. But if it's got that equity in it, it's likely that you can just as easily borrow against that equity to buy something else and add to it, and sit on Lithgow and let it take care of itself in terms of its income and expenses, and sit and wait for what may happen in the future, because there are a few small growth drivers there. It's a real fine balancing act, but certainly if it's not creating any financial difficulty for you to hang on to, if you're not just throwing good money into it that doesn't seem to be coming back in growth, it's probably not one that I would let go of. I'd just let it sit and bubble away for a little while. You're watching Your Money, Your Call, and we're getting some great questions. Keep them coming. We don't mind what they're about, as long as they're about property. For now, though, it's time to take a short break, but we will be back soon. And so if you have a question for anyone on the panel this evening, remember, the question of the week will receive my latest book, Investing in the Right Property Now. To be in the running for that book, all you need to do is call us on 1300 30 34 35, or send me an email to property@skynews.com.au. Now remember that email has to be either read out on the show, or we have to answer your question on the show, and then we have to pick your question as the one who wins the book. Not everyone who rings or emails gets a copy of that book. Stay right with us. We'll be back soon. Welcome back to the show, and you're watching the property edition of Your Money, Your Call, where tonight we're taking calls about investing in property. Now, tonight you'll be speaking with Brad Beer from BMT and Ben Kingsley from Empowerwell. And, of course, I can also answer any property investing questions that you might have. So call us now on 1300 30 34 35, or you can email us at property@skynews.com.au. Before we go to the phones, I'd like to tell you about my seminar, which is coming up tomorrow night, July 31. Now, in this presentation, I'll be helping you to improve your investing success and guiding you through methods of assessing hotspots so that you can always be the first to find them. I'll also provide my 2013 hotspot list so you can get ahead of the rest. Now, it's on at the Perth Football Club and starts at 7 p.m. sharp. So do come along. Tickets and venue information at destiny.com.au. Stay watching at the end of the show as I have some tickets to give away, and I'll tell you how to get them. Now, Peter has emailed this week to ask, a few weeks ago you spoke about transferring property assets between husband and wife in New South Wales. Our property is in both names. My goal is to remove our principal residence with no mortgage out of my name and put it into my wife's name to protect it from my other investments. Is it true that it can only be done as a sale and therefore paying stamp duty to the government on the market value of the transfer? If the goal is asset protection, is there another way to do it without paying stamp duty? The property is quite expensive and hence stamp duty would be a substantial amount. Ben, hiding assets.
Question, Peter. Yes. Look, one thing you need to understand, Peter, is that you're talking about stamp duty. Stamp duty is a state-based tax. Now, being a state-based tax, it means that whatever state you live in, they have different rules around stamp duty and the sale of asset or the transfer. In Victoria, we refer to it as a gift of love. And it's basically a transfer where you can gift up to 100% of the value of a property, and there's no actual stamp duty implications on that. Now, I believe in New South Wales it could be as much as 50% that you can transfer without any stamp duty provisions. I'm looking at Margaret, she's saying no. But definitely in Victoria, if you actually wanted to transfer the value of that property, you can do so without incurring any stamp duty. So it is going to depend on basically where you reside and obviously where the property is that you're transferring that across to as well.
Brad?
Yeah, I wasn't aware of anything in New South Wales that allow you to transfer.
No, it doesn't happen.
Stamp duty or your trouble.
Come to Victoria.
It depends sometimes, I suppose, on what your goal is here. If you're trying to protect the asset, then debt is possibly a way to have at least a little more protected, I guess, if it's not worth as much in the actual name. But transferring it across without stamp duty in New South Wales, from what I understand, is a no.
Yes, it is a no, because, you know, we don't like people to be transferring their assets around to protect them, because we have a lot of bad guys here, and they do that all the time. They try to get their assets all tied up so no one can get them. I'm sorry to tell you that since your property is in New South Wales, there is nothing that you can do about that. You cannot transfer by way of love and affection, which is a cute term that they use in Victoria to describe how they sneakily move their assets around between spousal partners or other members of your family. We can't do that here. We have to pay stamp duty as if it is a sale amount. So there's nothing at all that you can do about that property. It is in your joint names now, and so it shall remain forevermore unless you decide to sell it and then get on to some other property where in fact you might then be able to put it in single names. Well, if you've never heard of a vendor advocate, well, neither had I until Mary wrote and asked, I was just wanting some information on using vendor advocacy to sell my property. Is it a good idea or will it go directly to an agent? Ben, what's a vendor's advocate?
Oh, I must disclose firstly that we do have a vendor advocacy in our business. So it's basically a buyer's agent, but a buyer's agent who's working on behalf of someone who's looking to sell the property. Now, vendor advocacy is whereby you're engaged by the seller to find the most suitable agent to sell your property. So the role that they play is an independent role. When you're actually looking at choosing that particular real estate agent that you want to work with, they're going to basically sort through the chaff and find the good wheat and basically select that particular person. So they're quite independent. A lot of people forget this idea around property and agents. Agents are paid a commission if they're working for the vendor. So if there is a situation where the property isn't moving, well, the selling agent may not actually get commission. So there's what we call conditioning in the industry, whereby they may actually try and condition the seller to sell the property. A vendor advocate's job is to basically come in and make sure they're selecting the best selling agent who can sell the property, market it well, and do the best possible job, and they're basically paying for their independent advice.
Brad, have you ever heard of a vendor's advocate?
I've heard of them, yes. I didn't realise, Ben, that you had some involvement in that. Would I have used one myself? Well, I guess having some experience around the property industry. Now, I'm a bit of a buy and holder, so I haven't been through the selling process. However, seeing the property industry and the way properties are sold, and if you were very weak at the negotiation process, and I know sometimes how they do work, it's sort of, you've got to be really on the pulse and do a bit of research about what is the value of this property in the current market. You're choosing an agent because they tell you that they're going to get you more money is not always the case, because then they'll probably look and try to have to condition you down to a value that may be a very different number to what they told you. You need to make sure the agent is doing the correct work towards selling your property. What is the marketing campaign like? What is the process that you're going to go through to actually sell this property? Do you think they're going to get the job done? And compare them against each other to make sure that they've actually got some real things in place, like a service guarantee. If they don't, if they're not going to perform, this is what's going to happen to their commission, basically, for example. I haven't actually used that in the past, and I probably personally wouldn't, but then if you're not educated, then I know it's like a buyer's agent. Sometimes if you're not educated and you don't know, there's some valid reasoning behind maybe getting some professional advice behind things sometimes.
Sounds like some good advice there. Genevieve, from Queensland, you've got a question about rental rights.
Yes, we have had 3 different rental properties in central Queensland, and the one that we had somebody move out of in December we'd had for 9 years, and that person had stayed in it for 9 years. In that time, we used to go and check it with the real estates, and then we left that to them, but because the real estate we were with didn't look after one house, we actually changed real estate groups. When this woman moved out, she owed 4 weeks of rent. Initially, she paid $180 a week 9 years ago. She was now paying $280 a week. The real estate said, oh, no, but you're getting all the bond back.
Doesn't work like that.
The house had to have all the flooring taken out. There were fleas in it. There weren't meant to be dogs there. There wasn't a single curtain left in the place. It all had been taken or wrecked. We had to change all the sink, all the doors in every room. We spent 3 months getting the smoke stain off the wall. So we had three months, sorry, it took us 3 months to clean it.
So, Genevieve, what's your question for us tonight?
Do we have any recall to the real estate? Because they were supposedly checking, but actually checked in October, and they said the only thing that was wrong was the upstairs kitchen was a little bit untidy.
Okay. All right, Brad, of course, this is a really, really good reason why you have landlord's insurance, because then you don't have a problem. Does Genevieve have any recourse back toward the property manager?
Look, it's the whole way through that question, Genevieve, which is a horrible situation. I was thinking about landlord's insurance to make sure you've got those things covered. I've had a couple of situations where tenants have done things that are bad to properties. One of them ripped mine to parts. It had $6,000 worth of damage, but I have insurance in place to cover those things. No good for you now when you're already in this situation. I'm not really across your rights as far as an agent, as far as the property owner in Queensland. Somewhere like the REIQ might be a good place to go and find what the real rules are actually are, what the recourse you may have. But I suppose from an overall perspective, firstly it's about the insurance, and secondly making sure you're selecting a property manager that actually does a good job. And just because you have a property manager doesn't mean not to look at what they're doing, not to make sure you're looking at the reports at least they're providing, and making sure they're doing it every 6 months or whatever. I think it's more than that in Queensland they have to do it, or seeing what they are actually offering and making sure you're comfortable with what the number of reports are. Most of my property managers send me photos each time as well, so I actually get to look at them as well and make sure that is the case. It doesn't help you with your problem after the fact, but I suppose going forward and for other investors, making sure those things are done properly is very important.
Ben, it's difficult, isn't it? You can't really, you probably can come back to the property manager, but pursuing that is going to then cost you money and be harder. I think this is going to just have to be a lesson that you learn for the future with regard to landlords insurance.
Genevieve, in Queensland there is a tribunal and an arbitration type component to that. The first thing you want to have a look is your Tenancy Agreement Act and what it actually says as to what your property manager is going to do for you. And if they have failed in that duty and failed in the duty of care to look after your property, then you do have recourse if you wanted to take it to the tribunal. And I believe it is a tribunal up there as opposed to an ombudsman. In terms of that, that's the first process that I'll be going through in trying to explore it. In terms of if we're talking about full legal argument or full legal challenges, well then you're going to have to work out what the cost of that legal advice is going to be as opposed to what potential return you're going to get. But if you've got a signed agreement that they've agreed to and they've basically decided to provide you with certain things in that agreement and they've failed to do so, that's certainly a starting point.
Excellent. So that sounds like a bit of advice for you, Genevieve, and I'd be right on to that landlord's insurance for the other two properties that you say that you have, and then you won't have this problem at all in the future. Well, thanks for all of your questions so far. It's time again for another short break, but we will be back. Now, remember, you could receive my book, Investing in the Right Property Now, just by asking a question and then being the caller chosen by the panel as the question of the week. To be in the running, call us now on 1330 3435, or if you'd rather write it down, you can, and also email us on property@skynews.com.au. Welcome back to Your Money, Your Call. I'm Margaret Lomas, and tonight I've had the pleasure of the company of Brad Beard from B&T and Ben Kingsley from Empower Wealth, who are both doing a great job answering your questions. We've got a few minutes left, so now's the time to call with any questions and perhaps receive the book of the week. The number is 1330 3435, or you can email us on property@skynews.com.au. We have an email from Rob who asks, when looking for property, do you look at the type of structure that you're purchasing so you have some type of control over future maintenance costs? An example of this would be, do we purchase a weatherboard or cement sheet constructed property that may require to be fully painted externally in 3 to 5 years, or do you look at brick veneer that you know will not bite into your profits by requiring a full paint makeover? We've been looking throughout the Hunter Valley region and we have found 3 or 4 properties that are similar in price and weekly rent returns, and we're not sure which way to go with this choice. Brad, long-winded, but what's your response to that question?
Yeah, look, in regards to the type of property you're purchasing, I think every property you buy, there needs to be some sort of consideration of the future, I suppose you'd say, life cycle costing is probably what they call it in the world, but the cost of fixing things up, what's the sinking fund type things that you're going to need to fix after a period of time. And I think every different type of property that you do have is always going to have some of those things. You look at the age of the property and what the construction sort of is like. Some of your building reports will give you some information on that. Just because it's brick veneer doesn't mean you don't have upkeep at all. No, you don't have to paint it. Bricks have a susceptibility to movement and cracking potentially, especially if you're in the Hunter area where there's actually a lot of mining activity. I also don't mind the fact that sometimes with properties that you do have to paint, providing you maintain them properly, you've got the opportunity to change the look of the front of the property probably a little bit easier. In the 1980s, there was a lot of mission brown, a lot of dark bricks that aren't very attractive today. With a weatherboard house, you can actually change these things a lot easier, and things that you can repaint when you're looking for valuations and you're looking to increase the street appeal of your property. You've got the opportunity to change a lot of those things probably a lot easier.
And what about you, Ben? What's your response?
I'm sort of similar with Brad there. I mean, as a rough rule of thumb, I don't mind brick. Sort of it's more stable. There's less wear and tear. I have both brick and also weatherboard investment properties. So it really is going to come down to, I've sort of nailed it down to this idea of what's the demand in the area. When there's certain properties have intrinsic value attached to them, so there's something that will attract both an owner-occupier and an investor to actually buy that. That's going to help grow that value of that asset. In terms of maintenance, there's no doubt in my mind that if you're doing no major structural changes to that, then usually your brick home is more reliable unless there's a lot of movement, as Brad was mentioning earlier. In terms of the weatherboards, these days the weatherboards that they're building with aren't the solid hardwood timbers that we've experienced in the past, and there's certainly a lot more upkeep and maintenance on those types of properties. So the way in which I look at things is as a rough rule of thumb, I do prefer brick because it is a little bit more stable, but that's just a personal view at this point in time.
Look, I agree. I like to get them in brick and tile, but one of the most important things that I think you have to remember is that you buy the kind of property that is in the area. Sometimes it's impossible to get a brick and tile property, but it might be a fantastic area. The most important thing when you're buying an investment property is not what the property is made out of. It's whether or not it is in an area that is an up-and-coming hotspot. It's whether or not it has the growth drivers. After that, then see what kinds of property are generally in demand, and then go with that kind of property, putting in place all of the checks and balances and making sure that you get a building inspection done on the way in to make sure that those things that need to be upgraded are a long way in the future for you. Alison from Sydney, you've got a question about big tickets, is all I can see.
I'm interested in buying a property, and it's for sale for about $1 million. And when I've gone and done a check to see what it last sold for, it sold just as, that it was registered, you know, the way they register them when the property's sold.
Yes.
I found out that it had been sold just 2 or 3, 4 months ago for about a third of that. So for about, you know, about 300 and 400,000. Now I'm just wondering, how can that be the case? Like, it was apparently some sort of sale due within a family due to a divorce or something like that. But I find it interesting. So presumably they've avoided paying a lot of stamp duty. But how is that going to impact on me when I get a valuation for that property? Because I believe valuers look at recent sales in the area, including, you know, just tell me, what's going on here?
Yes.
Do you think?
It sounds to me, Ben, like this might be one of those property that has been transferred by way of love and affection, as you guys love to do down there in Victoria. And it's just a portion of that property that was maybe paid for. Yep. It could have been done in New South Wales, obviously. Stamp duty raised on that, and therefore the sale's been registered just for that smaller amount.
Look, and the Office of State Revenue, they won't miss this in terms of it might be on record as being transferred at that particular point. But that's not so relevant to you, Alison. What is relevant to you is an independent valuation. So it's worthy to go out and seek an independent valuer who's going to prepare a report that you are going to pay them for. So they've got no bias towards the property. They're basically going to go out and compare it apples against apples with other properties within a localised area of around 1 kilometre, and they're going to basically look at the floor plan, look at the construction type, look at the age, and just make sure that they're giving you that comparative analysis. Now, inside the report that you will get will be a list of properties that has recently sold. The sale value of this particular property is not necessarily going to determine what they're going to value that property at from an independent point of view. So make sure you seek out an independent valuation from a qualified valuer, not a real estate agent, not someone who's going to give you an appraisal. You will be paying for this report, but it is going to give you some comfort and some satisfaction around what the true value of that property is in the current market.
But Brad, I guess one of the things that Alison is worried about is that because it only sold 3 months ago for a registered price of $300,000, that the valuer is going to use that as a comparative sale and then say, well, it's not worth that money. They don't only look at one comparative sale, do they?
No, that's right. The concerning thing is it's probably going to show up in there as a comparable sale because it's actually the property, but it's obviously an off-market sale in some way. Either that or you're paying way too much for it, and an independent valuation of some situation should be able to find that out. They're going to hold a lot more weight in what the market is prepared to pay for that, as opposed to what someone on a other type of sale has done, even though it's so recent.
Yeah, Alison, I wouldn't worry too much about what's going on here. It's definitely something that's a little bit unusual. While I've heard of properties selling 1 month for 500,000 and then maybe 3 months over 6 or even 700,000, for this property to have been sold first of all at 300,000 and now it's being sold at $1 million plus means that it must have been some kind of an unusual sale where just part of it was being transferred. It may have been a deceased estate where the inheritors decided that they would sell their portion to the other inheritees. It could have been a divorce. It could have been many, many different kinds of sales. Now, what the valuer will do is he will try to find at least 6 comparative sales in the areas. So the sale that you are just about to rebuy again may make up one of them, or if it's been 3 or 4 months, there might be other ones that are a bit more recent than that. I do know that valuers like their comparative sales to have been in the last 3 months if they can possibly find them in the last 3 months. So I don't think you've got a lot to worry about in that regard. I think you'll find that the valuation that is done either by your bank or by an independent valuer that you retain is going to be pretty much comparative to other properties around it. Now, if this property really is being sold at that much over market value, and there are 6 other properties also at the $300,000 to $400,000 mark, then you are being ripped off, and you probably shouldn't buy that property. You should take that as an example and not go ahead. I've actually seen that happen before, Ben, where someone has looked at buying a property and it's been $800,000, and somehow they're trying to hope that the people don't check out what's going on around it and they pay over the market value.
That's right. Credit to you, Alison, again, for doing some research and finding out that information. One of the things that Brad and I were just also mentioning was it could have been a renovation. So there could have been a significant, it could have been a very poor asset in the first instance, and they could have completely rebuilt it, added several bedrooms and living areas as well. So I noticed recently I've got a couple of alarms up for different types of properties, and basically what happens with those is you get an announcement coming through. I had an announcement on one of my properties telling me it was a 3-bedder, when it's actually a 4-bedroom property.
Okay, some good advice from the panel. Well, that brings us to the end of another Pack Show. I'll be back again next Monday. And joining me then will be Michael Tees from Tees and Brett Hunter from Rain and Horn. Thank you to our guests, Brad Beer from BMT and Ben Kingsley from Empower Wealth, who will, of course, join me again in a few months' time. Now, our question of the week this week came from Michael from Melbourne. You are asking about Cessnock. Now, I'll be sending you my latest book. Please email me on your money, your call at destiny.com.au, your money, your call at destiny.com.au. Of course, I'll need your address to get the book out to you. If you missed out, you can get all of my books at any bookstore or from my online store at destiny.com.au. Now, if you're in Perth, you can't miss the Perth seminar. I'll be there tomorrow night, July 31, speaking about my hotspots and the latest tips for investing in property, and it's on at the Perth Football Club. I have a very small number of free double passes valued at $80, just 5 of them. So if you're one of the first 5 people to email me the subject line tickets to your money, your call at destiny.com.au, I'll send you the double pass. Make sure you can be there, though, because you'll be getting that off somebody else, and if you can't come, don't apply for the free tickets. Lastly, don't miss Property Success this Saturday starting at 9 a.m. and then repeating every 2 hours all day. I'm Margaret Lomas. Thanks for being with us. I'll see you next Monday.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.